Netflix is taking on legendary media Warner Brothers, and they just bid to buy them out for $82.7 billion. We are breaking down the final structure, the winners and losers, and why the deal could either be Netflix's ultimate power move or $83 billion mistake. We're also going to do a should you buy at the end of this, so definitely stick around. Let's break down the biggest deal that will impact my portfolio at least, and that's Netflix buying Warner Brothers Discovery. So I'm Noah Menhart, and right here at WealthTown, I build and protect wealth. If you want to join me? Just click that subscribe button. Also, give this video a like. Would pretty much help out with the channel. Thank you very much, and let's just check out what the deal actually is here. And let's start with the hard numbers and define the deal, because this isn't just a simple handshake, it's a colossal corporate restructuring. What do I mean by that? First of all, the proposed transaction values Warner Brothers at $72 billion in equity, okay? However, the real cost to Netflix is actually the enterprise value of $2.7 billion, because they are absorbing a massive financial chunk of Warner Brothers debt. So that's why we have some concerns. Now, not only that, a couple of more things. So the price that Warner Brothers Discovery shareholders are actually receiving a premium, a value at $27.72 per share, comprised out of $23.27 per share and about $4.5 per share in Netflix stock. So whatever stock you owned, you're going to receive a cash amount and some Netflix shares if you own Warner Brothers shares. Okay, so that's pretty much the deal here if you're a shareholder of Warner Brothers. Now, the debt burden, because that's a big problem, the deal severely impacts Netflix's previously good balance sheet, because they did have a good balance sheet and they're still having it, but Warner Brothers Discovery carries a large debt load, which was previously reported to be around $33.7 billion. Now, absorbing that debt changes Netflix's financial profile overnight. The stock reaction, well, obviously Warner Brothers went up. The stock immediately soared a roughly 6.19% on the news, and offering a major win for the shareholders. So congrats to you, Warner Bros. Shareholders. Meanwhile, Netflix stock sold off slightly in a 2.9% range. This is also where I did a little move on Netflix, but we're going to talk about what kind of setup I did for Netflix in a later video, because we're not going to go over charts in this video. We're just going to analyze the fundamentals of the deal. This is not a technical video, it's just a fundamental video. So let's take a look at who's getting what, because Netflix is buying a major year-long contributor to the entertainment industry. It's not like Netflix is buying nothing, they're actually buying a whole Warner Bros. Discovery company. Not everything, we're also going to talk about what they're not buying. So they are also spinning off a couple of legacy media, less valued assets like Discovery Network and CNN into new public traded companies. So what's Netflix actually getting for the almost $83 billion are as following. First of all, the major player, the crown jewel, that is HBO. Netflix gets a prestige, about that, just swallow the frog. They're getting prestige shows like Succession, like Sopranos, like, okay, The Last of Us, maybe not, but they're getting Game of Thrones, even Sex and the City, so a major package. Also Friends, so far. So because if you saw some of these on Netflix, they actually were paying a lease for them, and we're going to come to this later on, because that's also a financial hurdle that they're going to get rid of. They will no longer pay leases on these massive binge-watchy series. Also, they're getting IPO value. They gain ownership of iconic franchises. Just think about the DC comic universe, Batman, Superman. They're also getting Harry Potter. They're getting Friends. They're getting Game of Thrones, which I just... Check it out, I'm in one of the Harry Potters. So they could rapidly accelerate Netflix's long-dated goal to moving forward and they're actually removing a competitor and getting massive fan base if the deal will go through. Now, the unexpected asset here is, which is crucially for Netflix, because wanted to get into this a long time ago. They are going to get in then into the video game industry. Don't forget that not only that Warner Bros. Owns the DC Comics, they also own the DC game universe. They also would get that, and also would get Hogwarts Legacy. And I'm just saying, they could get into a major gaming industry. Now, don't forget that at the end of the day, as I said, they are paying some leases, so Netflix expect to achieve a 2 to 3 billion annual cost saving, because this mostly comes from combining opportunities and eliminating overlapping departments. A figure that while good for the bottom line spells, well, bad news for employee redundancy. So, who are the biggest winners and losers of this entire deal? Because heavy mega deals clearly have winners and losers. First of all, well, the winners are Warner Bros. Discovery shareholders. You are getting paid. You're the immediate winners, walking away with a significant cash and stock premium. So not only getting cash that you want, you can invest in whatever you want, you're also getting Netflix equity, which is pretty good. But this is also, we're going to get to Netflix later on, which I don't like. So also Netflix strategically gets a good cementation in the Netflix dominant number one position. Netflix cementing itself being the dominant number one position in the industry. By taking Warner Bros. Discovery off the table, they prevent any other major players, whether there's competitors like Paramount Skydance, which wanted to buy Warner Bros. Also, they're taking out big tech giants like Apple and Amazon. Amazon could have bought them. Apple could have bought them. So from a acquiring stance, these assets are mounting to a serious challenge. Now also we have some losers. Netflix shareholders, as I am, just got a little bit of dump in the price. The price was already going down, so maybe this is one of the reasons that the price in the last weeks was constantly going down. They already knew something. The deal is, as I said, so Warner Bros. Discovery shareholders are getting cash and equity in Netflix, meaning Netflix is going to give more shares, initiate more shares, meaning they're diluting their shareholders, because the price was fixed to the amount of shares outstanding. Now the price will be divided by more shares outstanding, so the price is going to go down. Is this already priced in with the 3% reduction and also the constant sell-off? Well, maybe not, because long term this is going to have major problems. The entire deal is going to weigh on the Netflix share price. Netflix currently trades at a high multiple 40 times earnings because it was a pure player in the streaming industry. By absorbing a legacy media company, analysts of course worried that the market will assign a lower traditional media multiple to the combined entity, hurting the stock price at the end of the day. Also, creative autonomy and culture, the fear that the traditional quarterly focused culture of, let's say, HBO will be infested by the data-driven model of Netflix. So, is this the time to buy some Netflix shares? Now, there are risks and there are rewards for this risk. So, if you're an investor, you should definitely buy now. That's the gist of it. If Warner Bros. Would disappear, in the long term, shares will rise because they're eliminating competition. If they do not buy Warner Bros., the shares are going to jump up once more. So the bull case is simple, that Netflix becomes an undeniable global entertainment platform that will continue to rise prices and absorb subscribers from Max, which formerly known as HBO Max. They believe that the 2 to 3 billion in cost savings will offset the debt and dilute it over time. Now the bear case is focused on the value and risk, because Netflix is taking on immense debt and trading in its pure play status for media giant status. They're trading one status for another status, and that was not what we signed on for. So regulatory overhead alone is not enough to keep the stock valuation. Ultimately, the goal is signifies a massive shift. This deal signifies a massive shift because Netflix betting its financial stability on securing its long-term dominance. But you know what? Let me hear what you think about this deal. Is it a good deal? For who is it good? Obviously, for Warner Bros. Shareholders, it's really good. But is it a good deal long-term for Netflix shareholders? Is it a good deal for the company? Is it a good deal for us, the shareholders? That's what I want to know from you guys. After you like, subscribe, and catch you next time. I'm Norbert Menhardt, and I build and protect wealth right here at WealthTown. Catch you next time. Bye-bye.